The tax office has recently announced that there is an $8 billion tax gap between what they are expecting individuals to pay and the tax that is actually being paid. So at the end of financial year approaching, I'm going to talk you through what some experts are claiming to be the tax office target areas this tax season. In addition, I'll go through some common tax deductions that you could possibly be missing out on. So make sure you stay tuned until the end of this video. Quick disclaimer, I'm not a licensed financial advisor, nor am I a licensed tax advisor. This video is for entertainment purposes only, based on publicly available information. So you should seek the help of a professional before you make any changes to your financial position. Now that's out of the way, let's talk about work deductions. You may be able to claim a deduction for a work-related expense where that expense relates directly to you earning income. It's important to keep proof of your expenses, such as receipts or bank statements. And in order to claim a deduction, you must not have received a reimbursement from your employer for the same expenditure. If you're a little bit unsure about the kinds of expenses you can claim, the tax office has an industry guide which gives you examples of the kinds of deductions that you may be eligible for. I'll leave a link in the description down below so you can find the industry guide most relevant to you. But as you can see, for an example, construction workers can claim things like sunscreen, protective clothing, and sun hats. A key tip here for some common tax deductions that are missed are last year's tax agent fees, any licenses or memberships that are directly related to your job, and if you pay any income protection insurance outside of your superannuation fund, this may be able to be claimed as well. Hey Tomo. Hey Batman. I had to pay a substantial amount of money for this protective suit. Do you think I could claim a tax deduction for it? There doesn't look to be a superhero category in the industry guides. Can I presume you're paid by Gotham for your crime fighting services? That's right. My last pay rise sucked though. The cheapskates barely keep up with inflation. Right. So because it's directly related to you earning income, and like the construction worker, because your suit has functions that protect you from specific risks or injury, it generally should qualify as a tax deduction according to this document. Might be a silly question, but do you work from home at all, Batman? Nope. Well, in case you were interested anyway, whatever. The way the work from home tax deduction is calculated changed last year. You have two methods to choose from, the actual cost method or the shortcut fixed rate method. Under the actual cost method, you need to keep records to prove the amount of your home office expenditure. Things like stationery, depreciation on home office equipment, internet and data usage, and the portion of electricity, heating, gas that relates to your home office workspace. This method is a little bit harder to use because you're supposed to find out how much electricity your home office appliances use from the manufacturer, and then multiply that by your cost per unit of electricity, which you can find on your electricity bill. I'll leave a link down below if you want to use this method. Otherwise, you might consider the shortcut fixed rate method. This method allows you to use a fixed rate, which is 67 cents per hour that you work from home, to cover all your consumables, so things like internet, mobile, and electricity. Under this method, you can also claim a separate deduction for the depreciation of your home office equipment, but it's important to keep a record of the hours you work from home, things like timesheets, a work roster, or a diary. A key pitfall here, which is important to remember, is that under the fixed rate method, you cannot claim a separate deduction for your mobile phone and your internet, as the 67 cents covers this, and this will be a key focus area of the tax office this year. Also, if your workspace is not 100% for business use, maybe use it for personal use, such as gaming or something like that, then you might need to apportion your tax deduction to only claim for the work-related percentage that it's used for. If you have a work vehicle that is 100% used for business purposes, then you can claim tax deductions like fuel and oil, repairs and servicing, interest on any loan for the vehicle, lease payments, insurance, registration, or possibly even depreciation of the vehicle. However, if you use that same vehicle for private purposes, and remember, driving the vehicle from your personal home to the office is generally private travel, then you can only claim a tax deduction for the business use portion. And in order to determine that, you need to keep what's called a logbook for a 12-week period. The good news is once you have completed this logbook, it's valid for a 5-year period. Now, the key tip here is that if your vehicle has a really high business use percentage, then the tax deductions you are able to claim is generally worth the hassle of filling in a logbook. If you couldn't be bothered with all the admin, then an alternative method you could use is the cents per kilometre method. And for 2024, this is 85 cents per business kilometre travelled, up to a maximum of 5,000 kilometres. You don't need a logbook in this instance, but you do need written evidence of how you've calculated your business kilometres driven. This 85 cents per kilometre takes into account all your running costs. This method will be a key focus of the tax office this year, so be sure you have records to support the tax deduction that you're claiming. The tax office has recently announced that after an audit, they have found errors in roughly 90% of the tax returns that include a rental property. Some of the focus areas include rental income diversion, which is the incorrect apportionment of income and expenses in a joint, equally held rental property. For example, allocating the expenses to the partner that has a higher taxable income. Another target area will be holiday homes that are fake rentals or genuinely not available for rent. Rental property owners can only claim tax deductions for a period where the property is rented out or genuinely available for rent. And this is try to avoid people claiming tax deductions for their personal holiday homes. False claims for new rentals. When you make a repair of something, it is generally okay to claim a tax deduction. However, when you make an improvement to something in a rental property, such as ripping out a kitchen and putting in a whole new one, you generally can't claim a tax deduction up front. It has to be claimed over a number of years. The depreciation rules around rental properties changed in 2017. From that period, when you bought a rental property from someone and that property came with depreciating assets, you could no longer claim a depreciation yourself after you had bought that rental property. Things like hot water systems, air conditioning units, those sorts of things. You could only claim a tax depreciation for any new depreciable assets that you have installed in the property. There is a second component, however, that was largely unaffected by the changes, and these are called capital works deductions. These are things that are structural to the rental property, such as your roof, walls, or even adding an additional room to the rental property. Capital works deductions can generally be claimed over a 40-year period. So if your rental property is not that old and you were not given the capital works schedule from the seller, then have a chat to your tax advisor or to a surveyor, because for a fee they can normally populate that schedule for you, and you don't want to miss out the tax deductions that are available for capital works. A key tip here, and you'll see this is starting to become a theme, is that you need to be able to substantiate your deductions that you're claiming for your rental properties. So you should be sure to keep any invoices, receipts, bank statements, and any listings that you have that demonstrates that your property was genuinely available for rent. Also be careful if you're renting your property through platforms such as Airbnb or Stays. The tax office has numerous third-party sources that you can rely on to determine if you're receiving rental income or not. And if you're someone who likes to invest on the side to earn a little bit of extra money like I do, the tax office will have a focus on this year, especially investing in things like cryptocurrency. And this focus is due to the idea of the anonymity that applies to people who buy crypto. However, the tax office has said that they receive reports on people who buy and sell crypto and will target those people who are not including any income in their personal tax returns. If buying and selling investments is not your primary source of income, then generally for most people, cryptocurrency will be classified as what's called a capital gains tax asset. This means you get taxed on any profits that you make, but any losses that you make does not reduce your taxable income. Instead, you have to use those losses to offset any gains you make on the sale of your investments in the current year, or if you can't use it in the current year, you have to carry it forward to future years to offset any gains in the future. There's a bit of a process for calculating what your capital gain is. I'll leave a link in the description down below that can help you with this. Now, a key tip here, depending on what kind of taxpayer you are, so for example, if you're an individual or a trust and you have held the investment for at least 1 year, then you may be eligible for up to a 50% discount on any capital gain that you have made. But be sure to seek the assistance of a qualified tax advisor in determining your eligibility for this. I'm on the mission to grow my YouTube channel, so if you want to come on that journey with me, make sure you punch that subscribe button. And if you want to continue to level up your finance IQ, make sure you click on this next video.